Hello, everybody. It's Sunday. It's March 1st. This is technically the first day of meteorological spring, and I like springtime. So everything grows, weather gets nicer, warmer, etc. Today, this is going to be a big one, but it's tons and tons of charts and TA, and very interesting set of questions. A lot of things got the attention of people over the last week that are very different to normal. So we're going to break down a whole bunch of TA, a whole bunch of back testing, a whole bunch of methods. We're going to look at things like ONDO, MicroStrategy's STRC, yield, again, borrowing against your crypto, the rules. Should I buy a house? Should I invest and buy a house in 5 years? What does 2028 look like? And so much more. Impact of ETFs on Bitcoin, and can Sol get to $10,000? Crazy stuff. Crazy stuff. Don't shoot the messenger. I'm just answering the questions with data. That's it. And this is called 2020 Gambit, and this is not financial advice. I'm going to go through this fast. All the questions come from Patreon. Big thank you to everyone on Patreon too, and the mods in the chat. Shawnee, TND, K8, everybody else being there. Cypher Sniper. Let's get to the first question. It's from B Sunny. You said in the past that if it wasn't for the ETFs, Bitcoin would never have gotten to the price levels it did. I used to think this made sense. But then if the ETFs, companies like MicroStrategy and possibly sovereign wealth funds, buy their Bitcoin on the OTC market as to not impact the markets, then how do we associate the rise in Bitcoin price with the ETF inflows? It also makes sense, it also makes me think of what Marty has said on DCA a couple of times about how the price is controlled. Is everything just a story to make us think we understand why the price does what it does? I'd love your thoughts. Great question. I like the way you think. When the ETFs first came out, I analyzed the actual money flow every single day and the impact on price for years. And we have a basic judgment. So the ETFs are the big driver of Bitcoin price. MicroStrategy, consider that like a bonus package. But basically, we know from the very beginning, every 10,000 Bitcoin that was purchased aligned with about 3.5% rise in Bitcoin's price. 10,000 Bitcoin, a lot. And also, in dollar terms, every $1 billion of net Bitcoin ETF inflows rose the price by about 3.6%. And on the flip side, every $1 billion of outflows took the price down by 3.4%. We can measure this very specifically with a very high degree of correlation. That is the fact. Now, there's some weird things that happen behind the scenes, but let's look at the simple chart first, one of the many charts we'll look at today. So if you look at the history, these are weekly numbers of weekly flows since January 2024. As the money came in, yes, there were some down weeks. And ever since, what is the date? I want to make sure I got the right date. Ever since approximately November 1010, say 1010, the Black Swan event, 10th of October, 2025 last year, the ETFs have sucked. However, they have had, call it 3 or 4 good weeks, especially one very good one. And the one we had just this past week is not too bad. So the ETFs could be coming back. But I want to point out something here. When we had the Big Dipper around March 2025, after the tariff tantrums or during, you can see we sold off hard for 7 out of 9 weeks. And the Bitcoin price fell all the way down to, I can't remember what it was, around 80K or so. 70K. But then it shot back up, and you can see the peak of the market was exactly the 3rd of October, 2025. The weekly net inflows were about $3.3 billion, and the price was about $123,000. Since then, the ETFs have been selling off all the way down to the price we have now. Total net assets, 83 billion versus 164 billion, which is half. But remember, the price of Bitcoin is also half. So that has a big part of it. So net, when they do sell off, when we get negative weeks, the price goes down. And that's a simple matter of fact. And I can prove that 100 ways to Sunday. But there's some other things that are a little bit unusual as well. ETF is one part, but ETFs do drive probably 80% of the correlation of price because it drives a lot of sentiment. And this is the big thing we need to think about. ETF inflows, they so far have purchased 904,000 in net spot ETF, but it's been selling off since October. And again, these flows took the price of Bitcoin from 42,000 straight up to 126,000. That was the market peak. And there is a very high correlation. The R squared is about 0.8. So that is definitely true. But there is another theory, and I know a lot of people, you mentioned the name Jane Street, people go, oh, Jane Street, you're blaming James Street for everything. No, I'm not. I'm just pointing out facts. But there is a school of thought, shout out to James Levish as well. He's had a big Substack on this as well this week. But there is a misconception on over-the-counter and ETF mechanics. And yes, when Saylor buys, he buys over-the-counter. I think he'd do a lot better if he just set up an automated process to buy off of, Coinbase, etc., rather than doing OTC. I think he could do a lot better. Anyhow, checking this out, this is a typical thing is like on the left, it's what you think happens when you buy IBIT shares, for example, or FBTC, etc. The AP, like a Jane Street and others, creates new shares and they buy spot on the exchange immediately. And then you get immediate price discovery. But the reality is that doesn't happen. Maybe, allegedly. We're not sure, but we're pretty sure. But you buy IBIT shares. The AP sells the shares first. And then they hedge with futures, not spot. And then Bitcoin sourced later via private OTC. And there's a delayed opportunistic price impact. Now, I saw this over the first 3 to 4 months of analyzing how the delay, I spoke about, you have to buy the Bitcoin within 24-hour period, but sometimes it was 2 days and weekends got in the way. There was a huge delay. And every single time, imagine $1 billion came into the ETFs, they would wait for the price to dip 24 to 48 hours later to buy. So they sell it at a price where the Bitcoin price is high and the ETF price is related, and they buy them low. And I watched this and monitored it. You can watch the videos from a year and a half ago, and I basically discovered what is exactly happening now. The truth always comes to light over time. So that's one theory. Now, the other thing as well, yes, these APs, Jane Street, etc., they basically cut the Achilles tendon of price discovery because they artificially wait and maybe suppress. And that is the big story here. So the final verdict is yes, when the ETFs gobble up a whole bunch of Bitcoin, yes, it is, I believe, the primary catalyst for the entire cycle. However, the OTC clearing mechanics can absolutely impact the price discovery to negate some of this price discovery. But overall, price is made at the margin, and overall, the money coming into this asset through the ETF vehicles from TradFi, etc., wouldn't have been there if it wasn't for the ETFs. So no, we didn't see the full price explosion that we would have seen in the past because of maybe some shady things that were happening. But at the same time, net, it does drive the price up over time with some noise around the edges. So that's the easy way to think about it. So again, and one thing I'd like to mention too, this is not isolated to Bitcoin. This has been happening for decades with gold, with silver, with stocks, etc. The selling order flow and stuff from exchanges like Robinhood to Citadel and others. That's just the game. And whenever there's money, greed can creep in and people figure out clever ways to make a little bit more money on the money, follow the money. When there's money involved, some people become a little bit slim shady. Anyhow, hope that helps answer the question. User 28. Hi, James. I've been doing a lot of back testing as of late, and I'm finding that trading on dips, mean reversion, but on weekly chart is far better than shorter time frames such as daily or 4 hour. Now, I tested this on both Bitcoin and Tesla. This also got me thinking, particularly in a downward market, this type of approach would lead to being a better trader as it promotes patience as well as allowing you to stack your cash. We'll talk about cash later as well. Any thoughts on this? And have you tested weekly versus daily? I have tested every time frame for decades. I used to do back testing myself manually in the 90s. I used to spend, the week kind of trading a little bit and the weekends back testing my trading methods and TA stuff and everything else. I'm going to walk through a series of charts now to break all down exactly what we're trying to say so others can follow. And I like the way you think, user 28. First of all, we're going to look at two types of trend charts. And by the way, you know I'm a believer in confluence. You got to look at, say, trend and confluence models and mean reversion altogether. The more ingredients you have in the pie, the higher your probability of winning. But we're going to look at the optimized trend first. The optimized trend is a specific trend model designed for every single asset based on their history, based on their volatility, based on their Sortino ratios, etc., etc. Let's look at this one. This is the optimized trend for Bitcoin. And you can see here, and this is on the weekly, and the top back in 2022 was 69K. It turned at 47K. That's when the optimized trend goes from blue to gold, yellow, whatever you want to call it. Bottom 15.5K, but the trend didn't turn until it hit 22K. And then we had another turn at 105K in the most recent cycle. So on the weekly, yes, this is good. It cuts out a lot of noise, but you do miss a little bit, like the 69K to the 47K. That's a bit of movement. And then the 15.5K to 22K, that's like $7,000 of movement too. You miss that. And that is a large percentage amount. But there's more. Let's look at what this looks like on the daily. You can see here, we had the turn at 117K on the daily time frame versus the turn at 105K. So it's a lot more precise. And we had the first bottom at 84K, but then it turned again at 87K, which is closer. And then it turned down again at around 90K. So that's the easy way to think of the difference between the daily and the weekly. Basically, the daily is a lot more precise. The 4 hour is my swing trading window. That's even more precise again, but to not inundate you with thousands of charts, we're going to just focus on the daily and the weekly. You get the message where I'm going in a minute. Now, if we look at Tesla, before we look at trend, the trend chart, different to the optimized chart, the trend chart has 4 different settings too. We'll get to that in a second. Tesla, on the weekly, the top back in 2021 is $401, bottom 106, it turned to 295. So from 401 to 295 in the weekly, that's a huge swing, okay? Massive swing. Again, it's a very volatile beast. And Tesla is driven a lot by narratives and, selling shares to buy Twitter and spats with maybe a US president and getting involved in politics, all that type of stuff. That drives a lot of the price. But the bottom 106, then the turn at 195. So the stock nearly doubled on the weekly before it turned. And again, turn at 235 down, turn at 197. You get the idea, but I have a better way to prove it. But that is the weekly. If we look at the optimized trend in the daily, it's a lot more precise. You get signals a lot closer and you get to trade a lot more. But I'm going to make it even more scientific because we're talking back tests here. Now we're going to look at Bitcoin on the weekly and Bitcoin on the daily using the trend model on tight. Not loose, tight. And this super tight, loose, and super loose. Okay, we're using tight because you get even more precision. But now we have a back test. And with that back test, we can calculate what would happen over 7 years with Bitcoin. So if you just traded when the color changes, you buy when it goes blue, you sell when it goes yellow. You do 24 trades over 7 years and you make 13,145% ROI. Basically, you turn 10 grand into 13 million, or is 100 grand, 10 grand. I can't remember which one it was. And the point is, win rate is very high and the ROI is very high, but that's on the weekly. And you got to wait 7 years to do 24 trades. So call it 3 trades a year, give or take. But that's the weekly. Now, let's go to Bitcoin on the daily on the trend model. Remember these numbers. This was 13%, 13,000% return, 100% win rate. This one is 97% win rate, but 647,600% return over 7 years. You do 177 trades and your ROI is 50 times higher. And again, you can't see the different color changes in this because it's 7 years of charting all in one screen, but you get the idea. The back test shows you. Again, just buying and selling back tested on the color. Okay. Now let's look at Tesla on the same thing. Tesla on the weekly trend model. Same thing again. 7 years, 27 trades, win rate 96.3%, ROI 4,894%. Not bad, not bad. Let's flick that the last 7 years to the daily. And here you can see 40,000% ROI. The win rate's a lot lower, but it doesn't matter because you do a lot more trades and you win. When you win, 80% of the time you kill it. You do 118 buys and 118 sells, and you turn $100,000 into $39 million of profit. That is the difference, okay? The ROI here is 8x higher. Bitcoin is 50x higher. And that's the difference between the daily and the weekly. And when you go from the daily to the 4 hour, you can trade every 4 to 6 weeks with great success. Again, as long as your back test has a win rate of 80% plus, dial the rest in and you make a killing. So let's talk about the quick summary here. Back tests align with reality. Daily 4 hour charts generate 7x to 50x more signals and more profits. The higher time frame, yes, it does filter out the noise, but you leave a lot of money on the table on the weekly. Now, I do want to say one thing as well. When you look at things like Bitcoin, okay, Bitcoin is a strange animal because it does have these very long cycles. So the weekly will pull out all the noise, and the weekly trend tends to stay down for long periods of time. So if you look at this chart one more time, Bitcoin on the optimized trend on the weekly, you can see it turns down at 47K and it stays there until 22K. So the whole bear market is basically chunked in that one color. Same thing we're in today. But we'll get probably a lot more diminished drawdowns this time around. A lot of weird things have happened this cycle. A lot of things have changed very fast. We had the Black Swan event that left a bad taste in people's mouths. We have other things happening with AI, other assets, gold and silver. It's just everything is different this time and correlations are completely off. But getting back to this, shorter time frames mean you trade more and make more money. If you're only looking and want to trade once or twice or 3 times a year, the weekly works for you, but you'll leave a lot of money on the table. Okay. And then again, as I mentioned, Tesla is driven by the narrative. So you always have to keep your head out the window as well. And one other thing I do want to mention too is what you can do, because you did mention cash. You make more money on the daily, but you have to trade more. And sizing matters. And this goes back to what I've always said and I learned this a long time ago. When markets get to new all-time highs and get very toppy and valuations get very high, that's when you hit the pause button. You stop buying certain assets at certain prices. You wait and you start hoarding cash from whatever income sources you have or your rental incomes, etc. Start stocking that cash aside. And sometimes you got to wait 6 or 9 months before you can actually deploy. So at tops of markets, you stop buying and you start hoarding cash and you start getting rid of some assets as well. And this is very, very important too. And I just want to shout out to Greg Abel. He's the new Warren Buffett. He says the same thing. Basically, our balance sheet is a strategic asset. They are 37.1% cash. And they wait and they wait and they wait for a financial storm to roll through. And then they deploy. Now, Warren Buffett over the last 20 years or so, he's seen a lot of financial storms, but he didn't deploy. He was still very conservative. Will this new Greg Abel guy deploy if there's a storm? I think so. And we had storms like, for example, April 2025, beautiful storm. Nvidia falls to $88, down from 200, things like that. So you got to wait for those moments. And the baseball terminology is for a fat pitch. Somebody to throw you an easy ball, and then you take out your bucket and you clean up. So daily or 4 hour, even 12 hour, if you want to trade more and make more. Thank you for the question. Next one is from Crunchy. Looking for some thoughts on buy now versus invest first decision. Due to recent life changes, I don't currently own a home. I have a low 7-figure amount that could go into buying one now, but I'm considering investing it for 5 years and buying later instead. Not buying would cost about $50,000 a year in rent costs, roughly $250K over 5 years. So your rent is about $8,000, $10,000. Must be a nice home. Average home, my location is $1.5 million. I also have a mid 6 figures in the market now, mostly Tesla, Bitcoin, Sol. I'm 66 and unexpectedly back at work rather than retired. How would you weigh this decision and what are the risks I should be thinking about? NFA, of course, very grateful to be part of the community and using the AI tools extensively. This is a great question. And I think about this all the time. Okay, this is so interesting. And I'm going to give you a very detailed answer because there's a lot of things that I see out into the future and out into 2028 and 2030. We are going to see the biggest transformation in the history of the world. And that impacts buy now or later decisions like a house, because you're not going to get another opportunity to stay vested now. Take that 1.5 million, drop it in a home, pulls you out of a huge opportunity cost that we're only going to ever see once in our lifetimes. Okay. Very, very strong opinion on that. Now, your median, you mentioned 1.5 million, January 26. Your house, if you are in a regular place, will go up 2 to 4% annual appreciation. That is what we expect through 2030. So that doesn't even cover inflation. Go look at the price of car insurance or stuff like that, medical insurance, all those things. Doesn't cover it. Yes, it's a sort of a hedge, but not a very good one. And your 5-year projection, a $2 million cash home or 1.5 million, etc., will go to, imagine just 2 for simplicity, will go to 2.2 to 2.4 million at 2 to 4% appreciation over 5 years. Easy way to think about it. And remember, your home equity does give you that personal use value, but as you grow older, I do advise you to have less stuff. So the more stuff you have, the more headache you have. You don't need a lot to survive. I can live out of a suitcase for 6 months, not a problem. Won't miss anything. I don't have, as long as I have my laptop, I'll be fine. So start shedding stuff. A lot of people think they need a big house because they got a lot of stuff. As you get older, the more stuff you have, the more headache you have. So start culling, start minimizing all of the stuff. And that was great for me. It was a great cleanse when COVID hit, was just purge everything, get rid of boats and watches and just cleanse. I advise it. It's a very purifying experience. We're going down a rabbit hole now, but back to the story. Investing. What happens if you even invest in the S&P 500? You get 10.4%. That's a lot more than the 2 to 4% you get in real estate. And the other thing as well, did I mention real estate? You have to pay 1 to 2% maintenance per year. I forgot to mention that too. So even though you're making 2 to 4% after you maintain it and pay property taxes, etc., yeah, it's half of that. So bear that in mind. But everyone does need a castle, so I'm not killing that idea. But if you have a choice between deploying money or getting the big house, it's a very simple switch for me. Okay, and this is exactly why. You make a lot more. Even with blending stocks and Bitcoin, easily achieve 12% CAGR, 14%, and pushing 5-year balance easy could go to 3.5 million plus. And rent versus owning math, again, renting 3 to 5K a month or 8K. Don't feel you got to rent a place for $10,000 or $8,000. You can get a perfectly good house for $4,000, $5,000 in many places in the country. The other thing you can do is look at the retirement model. You probably have it. Easy with a very conservative 20% CAGR on Tesla. Dropping 1.5 million to Tesla will easily go to 2.9 million, doubling by 2030. But the real joy of this gambit is what happens in 2028 or 2029. And this comes from the Citrini paper. And they believe we could have another global financial crisis. We had the subprime crisis back in 2008. In 2028, exactly 20 years later, Citrini research believe there could be a problem with real estate because good loans, people start defaulting, people start having less income, maybe because of AI, and rates go through the roof. Nobody can afford a house, and ultimately real estate prices fall. That is the problem. If real estate tanks, you'll be there with your bucket like Greg Abel and be able to scoop something up in 2029 or 2030. If this happens. Now, I also do believe that high-end homes, like the $2 million range, you might even be able to buy a $4 million home in 5 years for $2 million because there'll be such a dearth of buyers. We see the exact same thing happen in places like Italy, etc. Big villas, they used to be worth millions. You can buy for 200,000 because there's nobody in the country that can afford to buy these things. And then the younger people don't want the big property to maintain and manage, so they go for nothing. So again, we've seen all this play out before. What I would recommend, without recommending anything, invest heavily next 5 years. And only if your family need a home, a stability home, don't do it. Invest and then be ready to swoop in with your bucket and buy a place. There's at least an 80% probability you're going to be a lot better off if you can wait for those 4 to 5 years to buy a place. Hope that helps. Strong words there from me. Now, back to another question from Yut. Hey, thanks for all you and your team do. Hope I don't misquote you, but if I recall, you mentioned along the lines of how DSL providers back in the .com era weren't where the money was to be made. It wasn't the infrastructure that made money. Rather, it was what was built on it that made the gains. I can't get the parallel out of my head, and that sounds a lot like L1s versus dApps. What makes Solana different, since it's essentially an infrastructure play? And as crypto matures, should we be less focused on the L1s and more on what's being built on top of them for gains? Am I off base here? Well, this is a great question, and I like the way you think. And for years, I've always given the analogy of kind of picks and shovels, pipes, versus where the real value lands. Now, there's a couple of things that are a little bit nuanced. Now, if you go back to my typical case, I remember back in, I think it was 95 or 1996, there was a company called Covad. And I know because I was a customer, I spent a fortune on their DSL. I'd won the first DSLs. I needed high speed internet in the mid 90s, and I paid a fortune for it. And I remember it took the guys like 2 days to set up at the house. But that company, Covad, people thought it'd be huge. And then .com bust happened. And then I think by 2005, 2006, it was dead. There's no money in the pipes per se. Now, that did enable the explosion of the internet, where the applications like Google, Amazon, etc. made a killing, but all pipes were completely commoditized. And that's what you have to be aware of. And the difference, though, is layer one networks, again, they are the foundational pipes, and the dApps are like the stores on top that sometimes make a lot of money. But the difference is, again, Solana is the network that handles all the transactions. And we're talking a lot of transactions. I'll show you in a minute. So there's a little bit of difference. And yes, there is a lot of value accrual, both to the L1 and to the dApps on top. But for example, if you look at the value mechanics of Solana, where 75% is staked and you get 6 to 8% back, there's automated fee burns, MEV capture, native yield, etc. And a lot of people believe 90% of the token supply is completely locked up. Not just the amount that's staked, but other stuff too. And also, there will be one elite base layer that handles all the transactions. My Gambit for 5 years now, since 2021, has been that is the one that's going to do it. But let's look at some more data and a balanced view. So I like what you're thinking. If you look at different dApps right now, like Hyperliquid, etc., they're making a killing. They're making a ton of money. You know, Hyperliquid and Solana both make the most amount of money out there. One is a layer one, one is a DEX. But you need to think both ways. Think of infrastructure winners like Cisco. Again, Cisco was not like a pipe that Covad made. Cisco is kind of like a router, and they generated massive returns. Massive returns. So best of both worlds is to structure your portfolio that has a little bit of both. I tend to be heavy L1 because you never know. The problem with dApps is they're very fickle. And users are very fickle. Users can switch allegiance at the drop of a hat, which is a problem. So you could enter a dApp that's a leading dApp today, and tomorrow it could be dead. So that's the important thing. Now, I will be touching on more Solana answers to questions that dovetail into this right now. Back to transactions. This is from Neo 2, and I don't know why there's so many Solana questions this week, but hey. You talk a lot about the Solana network and the value of the Solana coin. I'd like to understand how many transactions are on it. But if people don't need Solana coins to trade on Solana network, how can there be any real value in the Solana coin themselves? Again, big misconception here. First of all, let's look at the transactions. Yes, you actually do need a transaction, about 0.000005 SOL plus priority fees for a transaction. But remember, Solana transacts 75 million to 110 million transactions a day. And if you compare that to Ethereum, they do about 1.5 million. Solana yesterday did 76 million, and that's like 4,600% more. And it trades at less than a fifth of the market cap of Ethereum. Very strange. I have a theory. Maybe Vitalik is looking at this data, and that's why he's been selling so intently his Ethereum at the bottom of the market lately. I don't know why that is, or maybe he has to buy something. I'm not sure. But selling here, I don't know if that's a good idea. But the point is, transactions, you can make it up in volume. And this all attributes to the value of the chain. And also, when they do a lot of transactions, half of it's burnt. And this sinks the actual supply over time. And again, as I mentioned before, 90% of the coins are locked up. Maybe just 10% of the true float is available for long-term purchases. And that's the game we're playing. There's other things happening too behind the scenes, which are fantastic. We've been talking about the convergence between AI and crypto for years, and it's happening. It's happening. This is an example of where it's happening. There's one chain that does it all back to value accrual. And you can see the flywheel here. These are AI agent transactions, X402 transactions. High throughput, low cost will drive massive adoption. A lot of people now talking about billions and billions, even trillions of agents, all making transactions like crazy every single day. And again, they're going to do it on the best, cheapest, fastest, most secure network. And right now, already, all of the AI agent transactions, depending on the day, between 85% and 60% are happening on Solana. And again, it's not a free network. It operates as a required fuel and an ownership stake in the infrastructure. And I'm not the only one that's highly bullish. Okay, we have other things happening. Forget AI agents. We have payments. Okay, now we have big companies like Visa, PayPal, Western Union, and Fiserv. They all live on Solana today. It's not a POC. They're running 500 billion transactions a year. And that's before AI agents. And also Solana's way faster than Visa and Swift and Ethereum and Polygon and Base. Way faster. AI agents need instant finality. They can't wait 3 minutes or 5 days. Not going to happen. So, and this is also a little bit related to the previous. So I hope I'm getting the message across. There's a great question called regarding real world assets and ONDO Finance. And is ONDO going to kill Solana? Great question. What are your thoughts on ONDO Finance in the context of real world assets sector? Is it a competitor threat to Solana's position in the space? Boom. Everything is related. There's always connective tissue to everything in life. First of all, ONDO is a top real world asset name. Sector dominance, 2.7 billion TVL. But remember, it's a little bit different. It's a semi-private multi-chain architecture, and it's funded by TradFi, the BlackRocks, the Fidelities, a couple of other players in there as well, because they want control over their blockchain. They don't want to use something that they don't have full control of. And they are one of the top names in this space. Also, ONDO is not a true layer one because it's a permissioned at the validator level that only approved institutions can secure it and use it. Security is tied to their real world asset staking and is purpose built for compliant tokenized securities. Things like money markets. That's where most of the value is right now for ONDO. Money markets for BlackRock, etc. Now, what's also very interesting, ONDO is not a competitor to SOL because, first of all, it's not a true L1. Also, it uses SOL to tokenize 200 plus stocks on the chain. Again, as an institutional RWA settlement layer. So it's a win-win. The more successful ONDO is, the better off Solana will be too. That's great news. So the verdict on it, let's look at some more data. It is a top tier play. It is backed by big TradFi players, but the compendium score does not score very well. Also, another chart, if we look at the AUM on things like tokenized stocks, you can see here Solana wins with X stocks, not ONDO. So Solana's already does more, even though ONDO is kind of using it for some of their stuff too. And when we look at the ONDO chart as well, it's literally back to what it launched at. Hasn't gone anywhere. Yes, market sucks, but this chart keeps going down. Part of that is because of the tokenomics. The crypto compendium score is not very good. So hope that helps. Would I buy ONDO? Nope. Stick with Solana. Easier, simpler. Next question is from Peter N. First, thanks for this excellent group and your indicators. I'm looking into the Solana ETFs. But this is a very interesting question. I thought they can be interesting investing in when crypto market, including Solana, is as low as now. It's simpler to trade an ETF than the crypto itself. I was asking Grok about which one is the best selection of options. Grok came up with SOLZ. It has the options with the longest duration, also leaps. I was thinking of buying the option in January 2027 expiration time. The price now for this ETF is just below $9. Perhaps I can buy an out of the money option, like a strike of $15, since we're deep into the bear market and long time for this to expiration. You have said before, this strategy can be used many times like this in a market. What do you think of this? Brilliant question. You're kind of half right about some of this stuff, but let's break down SOLZ. When I hear SOLZ, I think LOLZ, LOLZ, SOLZ, LOLZ. What is SOLZ? First of all, it's not a true crypto ETF. It's a futures ETF. And it began in March 2025. And it gives exposure to Solana. But it's a futures ETF. And we've discussed so many times the dangers of these. Trading about $8, down from 27. And the current asset is, like you say, in the deep bear phase. So could be worth a position. But let's look at the chart. This is the SOLZ chart, and you'd think it would map directly to Solana since March of last year. Sort of downtrend. It actually looks like it's bottoming right now and about to turn up. But there is a danger. So the way you measure something is you compare it to something that it's supposed to be. For example, money to money, Bitcoin to M2, etc. This is SOL divided by SOLZ. And it shows you that Solana has outperformed SOLZ by 17.5% in 10 months. And if you've watched the show before, you know exactly why. You know it's coming next. Why? Well, a couple of things. If you look at the option chain, we'll get to the option chain first and we explain why it's losing so much money. The spreads are insane. The bid for an option for March 20th, 55 cents. The ask is $1.25. That's an outrageous spread. But not only do you get an outrageous spread on the options, but also on the stock too. And I've covered this many times. Remember, if you're buying a levered ETF or a futures ETF, you're going to get hosed. It's okay doing it for a holding for a week or two. That's it. Then get out. You will lose. You will lose because of fees, because of friction, because of spreads. And you get no staking rewards. And futures rolling costs, the big hidden killer, etc. Do not touch these options for every reason under the sun. Stay away. Don't get greedy. And never buy out of the money options too. That's a loser's proposition. And just remember, pure form, always, always. You're better off perping Sol with USDC somewhere than buying this. Anywho, back to another question. MVM 1974. What are your thoughts on the recent Solana model published by DFDV? I have read it and it looks interesting. Valuing Sol as an infrastructure, not as a company. It highlights the scarcity of the token, taking into account the players in Sol ecosystem, stakers, real world assets, stablecoins, agents. I think it's worth reading. Great stuff. And by the way, if you're wondering why there's so many Sol questions, part of what I covered earlier, the Citrini research report specifically spoke about how Solana and AI agents would disrupt TradFi, one of many big disruptions coming. And this all ties in together. So a lot of people are talking about Solana. AI agents just opened up the kimono for this asset. You know, we were hoping to onboard 1 billion users for years. Now we don't need 1 billion users. We just need 1 billion AI agents. Let's get into the digital city framework, which is what they discuss. They treat it fundamentally like a digital city economy. And for years, for 5 years now, I've been calling Solana the shopping mall. Every layer one is like a shopping mall, and its value is a function of the breadth of dApps, i.e. the different stores that are inside, like a Macy's and maybe a Nike, maybe Neiman Marcus, who knows what, inside the mall. That's exactly what they're talking about when they say a digital city economy. They're using my shopping mall analogy from 5 years ago. Anyhow, their new demand drivers Again, agents going to be huge. Real world assets going to be huge. Retail, institutions, payments, it's going to be huge. And they must constantly buy SOL for network gas. This is why I hold. This is why I stack. And I'm okay waiting till 2028 or 2030 because I don't want to take the risk of getting off the train too early. I'm playing the long game here. And the massive paradigm is it abandons, again, traditional company valuation. And for years, I found 60 different ways to appraise crypto. All sorts of ratios and market cap per user, per transaction, fees, DEX volume, all that type of stuff. They're doing the same thing. Now, scarcity is quantified. They go back to just 10% of supply will be available for bid. Then it's going to go to the moon. And then they talk about a stunning $10,000 SOL price target. I can hear the groans already. You don't need to say $10,000 this guy. But I am not talking about my $10,000 target. I think we get to 2,000, 3,000 by 2030, 2032 pretty easily. But what they look at is this, and they broke it down into 4 buckets. They look at bucket 1, which is real world assets, and they attribute a truckload of demand, about $525 billion of demand for that, for real world assets. The tokenization of everything, it'll be happening on the fastest, best, cheapest chain. That's why Visa and PayPal and Western Union are all on Solana already. Bucket B, stablecoin settlement reserves. Stablecoins will be huge use case, and we're only just getting started. Then bucket C, agentic AI. They only have 27 billion there for that. I would have had that a lot higher. I think, if you ask me what I think of this model, I like the buckets. I agree with the buckets. I would have way different weightings on the buckets. Yes, tokenization will be huge. Stablecoins will be nice and juicy, but agentic AI will go to the moon. And then consumer demand. 50 billion. The consumer demand is going to be far outstripped by the agentic AI demand, in my humble opinion. But the point is, you add up all this value, you look at the free float of how many are available to buy, and that takes you to a price of $10,027 per token. Again, it's a model. All models can be flawed, etc. It's a very interesting starting point. And I will take this and tweak it my way and sandbag it. And it also assumes the demand for the tokens through the roof, which it will be with tokenization, real world assets, stable coins, etc. But is that supply really just 10%? Could it be 30%? Could people unstake and sell it when it hits a certain price? Of course they can. So tweak it there too. But either way, great model, super interesting. And the big takeaway on this model, and hello to the DFDV team, again, it captures and quantifies the network economic realities that are out there. It reinforces the exact positioning of why I hold the layer 1 in the first place is the premier base layer infrastructure for the future. And again, highly recommend the framework. I just need to tweak it in a few areas. So I love it. Thank you for the question. Next question is from Z Cloud King. Hey, James, you've said historically, don't borrow against your Bitcoin unless it's the bottom of the bear. Yes, it certainly feels like we're there now. We're close. I was waiting to rotate half of my double-digit Bitcoin bag into Tesla, but didn't get that far before the price crashed. When Tesla fell below 400, I couldn't help myself and borrowed against a portion of my Bitcoin bag on Coinbase. The interest rate is variable, but it's only 4.25%. By the way, 4.25% is great. If you can borrow under 4.5%, that's awesome. That seems like the best strategy to acquire some Tesla now at a cheaper price and selling some Bitcoin later this year when the price gets back up. I've been keeping my loan to value at 40%. So Bitcoin would have to hit 32K to get liquidated. And I have plenty of backup BTC and cold storage if we even get close. Thoughts on your strategy? I love so much about this. This is the way to do it. The only thing I'd recommend is you never know what's going to happen in markets. So I'd move the LTV down to 25%. But I like the way you have stuff in reserve. But remember, you got to be able to move fast. So what happens if there's a cataclysmic event or double spend? And, we've seen what happened on 1010. We've seen wicks go all the way down on different exchanges. So they could liquidate people. So just, for heaven's sake, get below that 32K because wicks are possible. And these these crypto lenders, they just rub their hands waiting to take your bag because they know it'll bounce right back up as well. So go to 25% loan to value. I love your strategies. A couple of good things as well. You're having dry powder available, borrowing against it. The rate's good. Tesla price, could Tesla go to 380? Yeah. Could it go to 450? Yeah. I think the market's waiting for some catalyst to hit. Your 67K, again, 40% loan to value, move it down. I want you down around 25%, which take it below $20,000. And the interest rate is great as well. Tactical edge, yes. If you have patience and you can wait, I do believe, and I said this, by the way, in 2 years ago, I said Tesla will be the faster horse over Bitcoin. Bitcoin price is the same and Tesla's doubled. So far I'm right. I still think the TAMs for Tesla are far bigger than Bitcoin, even though people think money is the biggest thing ever. No, it's not. Labor is bigger than money. Transportation is bigger than money, etc. And be careful out there, though. It could be a rocky year. So I love what you're doing. Do it. Just get to 25% LTV. You got the cash to do that. Next question. And if you want to read these slides and my notes in detail, hit the pause button and go ahead. But I'm trying to get through this as quickly as possible. 72 slides today. Wanderer 1. I'm looking to put cash into STRC, but wondering how they managed to get the price close to 100. I'm reluctant to invest as it's currently at 99.96. When I know it could drop to 96 or even lower at any time, I lose 4% of my cash holdings. Although I'm missing out on dividends, isn't it better to wait for a dip? When we had the Bitcoin drop last week, STRC wasn't impacted, but it was hugely 3 weeks ago. Doesn't make sense to me. Very interesting. I have a bag of STRC. In fact, I've played with kind of day trading it for giggles in a retirement account just for fun because you can scalp. There was a time in the early days you could kind of buy at 96 and sell at 98 and buy back at 97 and sell at 98, make $1 a couple of times over a week. But first of all, the asset has changed. This is the STRC history. You can see here, yes, we had some big dips, some big swings over time. And why did those swings happen? Well, you can see it started out slow and then it went up and then a big dip and then another big dip. And we had 3 big dips. But what were these dips? These dips were August 19th, November 20th, and Feb 5th, which weren't exactly correlated like things like 1010, the black event, the black swan event. But basically, after the IPO, it was volatile. There wasn't a lot of knowledge about it. People were kind of in and out, a little bit unsure. And then MicroStrategy built a cash reserve to pay dividends on this thing to alleviate fear in the market. Again, the market was also volatile, huge crypto market swings, and that also made, the market rattle a bit. Then 20th of November, we had the November panic. Price fell to about 95 and changed to a low of $90.68 and huge volume. But again, this was because of fear over MicroStrategy and FUD that was being spread about MicroStrategy spilling over to the preferreds. And then we had the 5th of Feb 2026, late sharp drop down to 93. And again, these things are there to be bought up. You'll notice when I buy STRC, which I share, I buy them when it takes a little dipperoonie because I know it's going to rebound back because it's a self-changing mechanism. The dividend is linked to bring the price back to $100. So if the price does fall, they jack the dividend, and now it's about 11.25%, which is delicious. Now, there's also something else happening, too, that we need to look at as well. All the charts today. First of all, the volatility is going down over time. At the bottom of this chart in red is the historical volatility of this asset. And you can see every time it dips, the volatility spikes. But now we are at all-time low volatility for this asset because the market cap, if it's big, it's well known, it's accumulated on dips. So back in the good old days, you could day trade this thing and make a fortune. That's much harder now because it's mature. As with a new asset, new profile, lack of liquidity, bit of uncertainty, lots of FUD, again, scares people. But again, it is yield mechanics that bring the price up around $100 par value. By the way, the price today is exactly $100. It's not 99.96. And it's systemically adjusted every 30 days based on the actual price. The question is it worth it? Yes, I think so. It's not without its risk, but if you have some cash, put some of it in this thing because of that premium. And yes, you could get that 4% dip, but it'll rebound fast. Is it worth missing out on that big 1% juicy dividend every month? We'll see. And yes, the violent dips, I think, are a thing of the past because of the yield arbitrage mechanism that's in place. And finally, I don't know if we're going to get those big dips anymore. We had the early days, what I call teething problems like a baby. And the logical conclusion is don't try time it. It's too hard. And it is a very attractive vehicle for a portfolio, very attractive for me because I'm heavy cash. Nothing like Berkshire Hathaway, but I think it eases a lot of pain. I don't like holding cash, but that return eases a lot of the pain of holding cash. So I hope that helps. Next question is from Digit. I know you like Anduril. ONDS is also in the drone defense business, but much smaller, and therefore maybe has a bigger upside. What do you think about ONDS? Appreciate your work. So I did mention ONDS, I think, last week as well, maybe in Octa. I can't recall because there's so much. But Anduril versus ONDS, there are two different players. Anduril is a giant worth $30 billion, but it's private. It's not a public company. ONDS is $5 billion market cap, about a sixth of the size. And they're trying to be a mini Anduril, but with boats, not things that fly. And boats are easier, much easier than things that fly and go at the speed of sound, where a boat will go through the water at 25 knots. Big difference. Easier to maneuver and navigate and stuff. And they do have pretty good boats. I did mention that they can go 1,000 miles one way and do stuff and come back. Let's look at the chart real quick. Volatile, but it is hitting support level at level 4 on the ATR. It does technically, if it could match the TAM of Anduril, you could say it has more upside, but I don't think their TAM is anywhere near that of Anduril. Also, the moats are different. But it could be interesting for a little trade here. Let me try zoom into level 4. It's about $10. Is level 4 in the ATR. Its all-time high is about $16. So we'll see if it turns around. I know there's a lot of defense needed in the world today, but there's a couple of things I don't like. Financials, not good. Debt, etc. But if they have extreme, this is from our dilution model, extreme stock dilution. That's 328% over the last year or so. Very high, and I don't like that. That will suppress price. So if you imagine there was no stock dilution, that chart would be a lot higher. Will the dilution continue? Do they have ample cash? Maybe. We'll see. Risk and reward, you can buy this now. It's hard to get Anduril. If they execute on aggressive plans like revenue targets, could do well. We had another company that has some aggressive targets called EOS Energy, but people lost faith in their CEO because they couldn't really stick to the same script. That's the risk of everything out there. Follow companies with really good plans and the ability to execute. That is so important in this space. Would I buy ONDS? No, I wouldn't. I think there's better risk rewards out there, and I'm very conservative too. Hope that helps. And speaking of helping animals this week, shout out to the team behind me. We donated to the Save Moon Camp to help support bald eagles. And they are buying land in San Bernardino dedicated for these beautiful animals. I love that. Thank you. And DCA tomorrow morning. So a lot to talk about tomorrow morning. And let's do some live questions. And I hope all your brains got a little bit bigger. And I love these questions because they make me check my thesis and learn a lot more too. That was the 2028 Gambit. Call it 2032 Gambit too. Duck and turn. With wide deployment of cybercabs, when 10 identical cybercabs show up to a location, how do individuals recognize which cybercab is theirs? This is a brilliant question, by the way. If you've ever landed in Las Vegas at the airport and you're in that huge parking lot that's just all Ubers, it's a zoo. But from what I understand, of course, Tesla have thought about everything. They have a thing called ultra-wideband, which is for precision entry. So the car actually communicates with your cell phone. It knows who you are, and it'll open the door automatically and close it when you're gone too. And if you leave your phone in the car, it'll also know you left your phone in the car. And it'll make a funny noise like beep, 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 beep. This technology actually is already in my Cybertruck and Model Y. It beeps if you leave your phone in the car, like when you walk away. I think that's ultra wideband. I may have the name wrong, but it's something like that. Again, it communicates with your device. Great question, Doc Intern. I like the way you think. Always think around the corners, everybody. Buckhorn is putting a CAGR of 50% on Tesla too high in the retire model. Cern Basher has it at 80. Yeah, I like to be very conservative. In fact, on the model earlier that we talked about, the guy thinking about buying the $1.5 million home versus Tesla, I had 20% CAGR. And at a 20% CAGR, your $1.5 million doubles easily by 2030. I think 50% is too high. Remember, things are very volatile. Now, if Tesla falls to 300, then the CAGRs explode because, the end target is the same. Destination is the same. It's going to be $2,000, $3,000, $8,000 stock, somewhere in that time frame between 2030 and 2032. But they have to execute. That's very important. And there's always execution risks. You have to bear that in mind. But go with, even if you make 25%, it's a killer CAGR. Killer. Now, historically, Tesla has done 50% CAGR over the last 15 years. But I think they're on the cusp of getting into much bigger markets, much more profitable markets. So theoretically, Cern Basher and I did a detailed video yesterday on a lot of this and showed our models. 80% is possible. Absolutely possible. Would I put it in my model and take it to the bank? No. I'm much more conservative with 35%. And with that, that's plenty enough already. And if you're selling calls against your position too, you've got extreme alpha returns. Buckhorn, be conservative. Bryce Assets, I have 5.25 Bitcoin with a cost base of 26K, 175 Sol, 53 Tesla. Keeping Sol, want to build Tesla. NFA, would you agree with converting 1.25 Bitcoin into Tesla? I would. Yeah. I think Tesla will be the faster horse for sure. And I've been saying that for years. Even though the price of Tesla has more than doubled and Bitcoin's been the same pretty much for 2 years. The thing is, timing is worth it. So everything you do in markets should be gently in layers at opportune times. So create a pair chart in your trading view, Tesla over Bitcoin, and then wait for the times. It's very easy to read, like a big snake. Buy the dips when Tesla's low and Bitcoin's high. Now, Bitcoin's low right now. If Bitcoin had a nice pump, like a pump to 80K, 90K, and Tesla's still at 400, that's the time to move some, for sure. Not financial advice. I'm still confident in Bitcoin, as I always have been, but you know how I allocate. That shows you where my risk-reward confidence is as well. Hope that helps. Charles Kincannon, would any of the AI tools have picked up the peak of October 2025? Recent AI tools group call, one observation, use the 270-day moving average and RSI. So the Tabby tool was built to identify when things got overheated. Bitcoin never got overheated. Never. So we never had a traditional top. And the tool was based on 21 different on-chain indicators over the previous 3 cycles. Everything was different. And we were supposed to get more signal from the on-chain indicators because of the ETFs. That wasn't the case. Now we're beginning to learn why. Kind of similar to how the previous cycle was manipulated. A lot of people are talking about maybe a little bit of potential price discovery removal for Bitcoin because of the ETFs, because of the APs. Read all about it online. I won't talk about it. I'm not casting any aspersions, but that could be part of the problem. Then we also spent a lot of time and money building the profit-taking model. If you had implemented the profit-taking model, that would have absolutely killed it because it stopped literally at 129K. So all the layers up to layer 10, except for one, hit. So it would have taken you out of your position in an optimized way. Other things too, I mean, the trend, like we covered, trend turned. I said years ago on Patreon in a post, I'm not selling my Bitcoin because I don't have enough. I was too low Bitcoin. And I am now back to accumulation mode in the low 60Ks. So hope that helps. Yeah, profit taking, trend, Tabby needs some tweaks. We got a version 2 of Tabby coming out as well. But still, it was, as usual, everything is kind of manipulated in the real world. Allegedly, apparently, who knows? Maybe it's all natural and not cooked. I don't know. And a big thank yous over super sticker, Sir Winston Martello, long-term holder, TBF 430, Halekila, B-Man, Sigma 103, Brainman, and Medaroy. Hope I got that right. Spoke for an hour straight. Thank you all for coming, my friends. Take care. See you tomorrow morning. Bye-bye.